Hey everyone, welcome back to my channel. Today we're diving into one of the most requested topics, the beginner's guide to picking winning stocks. If you've ever been curious about how to choose stocks that could potentially grow your portfolio and your bank account, then you're in the right place. By the end of this video, you'll have a clear step-by-step roadmap to help you make smarter investment decisions. Ready? Let's get started. The first thing you need to do is understand the basics of the stock market. Imagine you're buying small pieces of a company, called shares. When the company does well, the value of your shares may go up. When it does poorly, the value can drop. The trick is learning how to identify companies that have the potential to perform well over time. Some beginners jump in without knowing how stocks are traded, how indexes work, or even how stock prices are determined. That's a big risk. Before you buy your first share, take some time to read or watch beginner-friendly resources that explain key terms like market capitalization, dividends, and price-to-earnings, PE ratio. Actionable tip. Open a paper trading account, a virtual platform where you can practice buying and selling stocks with play money. This way, you'll learn how things work without risking your hard-earned cash right away. Real-life example. I had a friend who started his investment journey by reading up on how different sectors move, like technology, healthcare, and energy. He noticed that tech stocks often show rapid growth but can also be volatile. By understanding the basics, he found a balance between growth stocks and more stable dividend-paying stocks. The second step. Determine your investment goals and risk tolerance. Ask yourself what you're investing for. Is it for retirement that's 20 or 30 years away? Or are you looking to grow your money over the next 5 years to buy a home? Knowing your goals helps shape your entire strategy. Equally important is your risk tolerance. How much fluctuation can you handle in your portfolio without freaking out? If big market swings make you lose sleep, you might lean toward more stable companies or index funds. If you have a longer time horizon and can stomach ups and downs, you could explore high-growth stocks. Actionable tip. Write down your investing timeline and how much you're willing to risk. Keep that note on your phone or on a sticky note by your computer so you never forget why you're doing this. Real-life example. One couple I know had very different tolerances for risk. The wife was okay with more aggressive growth stocks, while the husband preferred safer bets like blue-chip companies. By clearly stating their goals, a down payment on a house in 10 years, they created a blended portfolio that matched both of their comfort levels. The third step is to look under the hood and investigate a company's health. This is known as fundamental analysis. You want to understand if the company is making money, how much debt it has, and whether it's growing year over year. Key factors to check include revenue growth, profit margins, and return on equity, ROE. Actionable tip. A quick place to start is the company's earnings reports. These are released every quarter and give you a snapshot of the company's financial well-being. Another metric that investors use is the PE ratio, price-to-earnings ratio. This tells you how expensive the stock is relative to the company's earnings. A lower PE can mean a more undervalued stock, while a very high PE might mean the stock is overpriced, or that investors expect big growth in the future. Context is key. Real-life example. My cousin once invested in a popular fast food chain simply because it was trending. After the stock price dipped, she decided to research its fundamentals. She discovered that while the chain was popular, its profit margins were shrinking and its debt was climbing. She realized she would have been better off investigating first instead of jumping on a hype train. The fourth step is to keep an eye on current events, market trends, and news. Stock prices can move quickly if a major story breaks, like a new product launch, changes in government policy, or surprising earnings numbers. By staying informed, you can make decisions that align with what's happening in the real world. Actionable tip. Follow reputable sources such as Bloomberg, CNBC, and the Wall Street Journal. Set up alerts for your favorite stocks, so you'll get real-time updates on press releases or big announcements. But be cautious, not every bit of news requires immediate action. Always check if it truly impacts the company's long-term health. Real-life example. There was a time when a huge tech company announced a major partnership with an automobile manufacturer. The stock soared because investors predicted big things from their collaboration. However, some people sold off in a panic when the market momentarily dipped a week later, missing out on long-term gains. The morale? Keep your strategy in mind and don't let short-term noise derail you. Fifth, consider a bit of technical analysis, which examines charts and patterns to predict future price movements. It can help you time your entry or exit in a stock. However, don't get too bogged down by complex indicators if you're just starting out. The goal here is to look for clear trends, like whether the stock's price has been steadily climbing over the past few months, or if it's bouncing up and down wildly. Actionable tip: check simple moving averages, like the 50-day or 200-day moving average. If a stock's price stays above these lines, it may indicate a stable upward trend. If it crosses below, it might be losing momentum. Start with basic indicators and gradually explore more advanced ones if you find them helpful. Real-life example. I knew a beginner who dived into complicated charts loaded with dozens of oscillators. He spent hours analyzing them but ended up confused. Once he simplified to just moving averages and trading volume, he found it much easier to decide when to buy or sell. Sixth, never put all your eggs in one basket. Diversification is crucial. If you invest all your money in just one stock, and that company faces a scandal, you risk losing a significant portion of your portfolio in a blink. By spreading your money across different sectors or even different types of investments like bonds, ETFs, or mutual funds, you reduce your risk. Create a mix that suits your goals and risk tolerance. For example, if you're into tech, great, but consider balancing it with more stable sectors like consumer staples or healthcare. This way, when one area struggles, another might do well. One of my mentors balanced his portfolio by investing in a handful of tech giants, a couple of reliable dividend-paying utility stocks, and an S&P 500 index fund. When the tech sector took a hit last year, his utility stocks and index fund helped cushion the blow. Seventh, if you really want to pick winning stocks, develop a long-term mindset. Quick trading or day trading can be tempting, but it's also risky and stressful for beginners. Historically, the stock market has shown overall growth in the long run, even though it goes through ups and downs. If you pick solid companies with strong fundamentals, you might be better off holding them through market fluctuations instead of panic selling. Try not to check your portfolio every hour. Daily price movements can drive you crazy and push you to make emotional decisions. Set goals for 6 months, 1 year, or even 5 years down the line, and evaluate your stocks at those milestones. A friend of mine bought shares of a well-known electric car company when everyone thought it was overvalued. He held onto it despite short-term drops, ignoring the daily noise. Fast forward a couple of years, and his position multiplied in value because the company kept innovating and beating market expectations. So that was the beginner's guide to picking winning stocks. Let's quickly recap the steps. First, understand the stock market basics. Second, know your goals and risk tolerance. Third, investigate the company's fundamentals. Fourth, keep an eye on market trends. Fifth, use simple technical analysis wisely. Sixth, diversify your portfolio. And seventh, adopt a long-term mindset. These steps may sound straightforward, but putting them into practice consistently is what separates successful investors from the rest. Always remember, no stock is guaranteed to be a winner, and every investment carries some risk. The key is to manage those risks with research, discipline, and a long-term perspective. If you found this video helpful, please give it a like, share it with a friend who wants to start investing, and subscribe to the channel for more content on growing your personal finances. Thank you for watching, and I'll catch you in the next video.